Welcome, ladies and gentlemen, and a good morning to you all. We're here today for the Troy Income and Growth Trust Investors Presentation with co-manager Hugo Yer. This presentation has been hosted on Research Tree by Doceo and Capital Access Group. As we proceed with this recorded session, investors will be in listen-only mode. We strongly encourage questions, which you can submit at any time through the Q&A tab on the right-hand corner of your screen. Simply enter your questions and press send. If you would like to leave feedback, please hold on at the end of the session and there will be a short survey you can fill in. While the company may not respond to every question during the meeting itself, be assured that management will review all questions and, where appropriate, publish responses. You'll find these responses on the event page of Research Tree. So without further ado, I'd like to pass the baton to Hugo Yer, co-manager of the Troy Income and Growth Trust. Hugo, a very good morning to you.
Thank you, Alex, and welcome to all of you dialing in or listening at a later date, and thank you very much for your time. We find ourselves in an interesting position as investment managers. We have shifted environment materially over the last 18 months from a zero interest rate environment to a world in which there is very clearly now a cost of capital. And this poses questions for the investment management industry, in particular around how we generate income and the role that equities have to play within a portfolio. And I want to spend a little bit of time this morning taking you through a few slides that will first introduce the trust and Troy, talk a little bit about our process, talk a little bit about what we think about the UK market today, and finally, how we see this portfolio and this trust fitting that role within the environment that we currently sit. Troy was established in 2000 by Sebastian Lyon and Lord Weinstock. They had a very clear vision of what they wanted to be, and that was around creating an independent boutique that managed money for absolute returns, managed money in a way that was not dominated by benchmarks and benchmark relative thinking, but really had the opportunity and the freedom to go out and invest in the way that they felt was best aligned with shareholders' interests and investors' long-term interests. And that idea of being independent from the benchmark, that idea of long-term returns is really critical to the foundation of Troy over 20 years ago. The other thing that's really important about Troy is our independence and the alignment of our managers and a lot of our staff. We are owner managed, so about 50% of employees are shareholders. And we are all invested in the trusts and funds that we run, as well as being shareholders of the company. So I talk to you today as a shareholder in this trust, aligned with you in that positioning. Troy has long been committed to investment trusts. We run 4 mandates, and across those 4 mandates, we have 3 investment trusts. And this just shows very briefly 3 of those mandates and the associated investment trusts. Personal Assets Trust, probably the best known, 1.8 billion of very defensively managed assets with a multi-asset mandate, a very much cash relative performance benchmark, and run by Sebastian Lyon and Charlotte Young. On the right-hand side is the most recent addition to our stable, which is what was STS and has now been renamed as STS Global Income and Growth Trust, run by James Harries and our global income team. And then in the middle, you have the trust that we're talking about today, which is co-managed by myself and Blake Hutchins, with the support of Aniruddha Kulkarni and Fergus McCorkle and the wider Troy investment team. And this idea of a single collaborative investment team is hugely important at Troy. We took on the trust in 2009, at the similar time to Personal Assets Trust, and we've grown it steadily to just under 200 million. And I think what comes across on this slide is this very strong commitment to investment trust that Troy has. We believe these are fantastic savings vehicles that it is a great privilege for us to run, and a place where we find truly aligned and long-term investors. And that's very, very important to us. Since 2009, when we took over the trust, and even before, really since 2004, when Francis Brooke set up our UK equity income franchise, we've had very clear aims about what it is that we want to do. For the trust, we sat down with the board at the beginning of this year to clarify those aims and to make sure they were presented to investors in the clearest possible way. And this is what we came back with, and is essentially aligned with everything we've been doing for well over a decade. We are aiming to deliver total returns above the FTSE All Share over a reasonable length of time, which is 5 years. We're aiming to deliver annual dividend growth from the trust of at least 4% per annum. And we'll talk a little bit about how confident we are in the robustness of that dividend growth in due course. And importantly for Troy, one of the key aspects of what we try to do at Troy is to deliver those returns with lower than average volatility. So volatility below that of the FTSE All Share. And what essentially we're implying here is that we are delivering our returns with less risk than the market. And the discount control mechanism, the DCM, which is flagged there in the circle, is an important aspect of doing that. We'll come to talk about that in due course. I've spoken about the aims, and this is the long-term history of what returns those aims have delivered. And you can see here that you have returns on the vertical axis, volatility on the horizontal axis, and you've got 3 dots, one which is the sector on the far right, Troy Income and Growth Trust on the far left, and the FTSE All Share, the index in the middle there. And you can see that from this that we've delivered over the long term returns above the FTSE All Share, broadly in line with the sector, but with considerably less volatility than both. And it has been our ambition as using volatility as a proxy for risk to make sure that we are well over to the left of our peers, but delivering a similar return or a better return. And ultimately what we want to do, and we're constantly trying to do, is drive that blue dot for Troy Income and Growth Trust further towards the top left, delivering an ever better risk-adjusted return. How we do this is a function of our independence and the structure and how we are set up. And we recognize that to deliver returns that are markedly different from the market, we need to have portfolios and an investment process and style that is markedly different from the market. And that means we are very choosy about where we invest. We're very choosy about the sorts of companies we own. And although this slide isn't an input into our process, it's a very good way of showing investors and shareholders the sorts of stocks you can expect the portfolio to be made up of, the sorts of places where we're expected to be invested. And really what the chart on the right shows is a grid or a table of capital intensity on the vertical axis and cyclicality on the horizontal axis. And what we find is that companies that are less cyclical, less capital intensive, have that ability to compound returns steadily over the long term. And that's very, very important to us. As you move from the bottom left to the top right, what you see is that cyclicality and that capital intensity increasing. And here you have stocks that are much more volatile, where cash flows and therefore dividends are much less reliable from one year to the next. And we tend to avoid these stocks. We would never say that good returns cannot be made by investors who are willing to be short term in their outlook. But for people or investors who want a portfolio of stocks that they can buy and hold and have some expectation of what those returns will be over the long term, we feel that actually the portfolio stocks in the bottom left, the Unilevers of this world, the Experians, the Crodas and Relics, are the sorts of companies that we focus on. And these are found in certain sectors: healthcare, consumer staples, business, software and services, much more than they are in some of the more capital intensive and cyclical airlines or industrial sectors. In the middle, we have stocks which are either a little bit more capital intensive or a little bit more cyclical, but we try and avoid the combination of the two. And this explains why in one simple slide. The world is more complicated than this, but this is a useful snapshot. Relics is the sort of company, as I've said, that we would like to own. It's the second largest company in the portfolio. it's one that we believe we can have a large holding in and rely on the returns from a company like this. And really what we're looking at is the progress of those blue bars on the chart. And that shows the cash flow from the company. The blue line shows the cash flow conversion. And what you can see is that free cash flow from the company has grown steadily over time, almost metronomically year in, year out. Now, there's a small exhibitions business within Relics, which when COVID hit was entirely shut down. And so you can see that very short blip in 2020. But importantly, we bounced back from that almost straight away. And what we've seen in the last year in the grey line is a 10% dividend growth, a 20% increase in free cash flow. On the right-hand side, what you've got is a company where those cash flows are much harder to predict and much, much more unreliable, much more volatile. You can see that 2021 was a bumper year. Metal prices were high. The company paid a high dividend, and the share price reflected that. What we've seen since is metal prices have moderated. These companies often make acquisitions at bad times in the cycle, and they are struggling with the integration of the Sirius Minerals acquisition. You've seen cash flows fall by 70% and a 30% cut in the dividend. And so, although there are snapshots where these companies will give you very handsome returns, we would much rather own stocks like Relics for the long term. The defensive, resilient nature of those cash flows is hugely important to us. So that gives an idea of the sorts of companies we own, and we'll talk a little bit more about that in due course. I told you I'd just touch on why we think the UK is an interesting market in which to be invested, and why we think in particular today that's important. The first thing I would say on this is it is hugely important not to conflate the UK market with the UK economy. And I think the simple statistic on the left-hand side shows why that's so important. 78% of revenues from the UK market come from overseas. The UK market is well endowed with an extremely strong portfolio of first-class international businesses, which earn a substantial portion of their revenues either in Europe or the US, and in some cases in Asia. And we have access to all of that through the UK listing and the UK governance, and also through through sterling and UK currency. And so that's the first reason we think this is the UK market represents a strong opportunity. The second reason we've been hesitant to talk about for many years, it's been something that I think investors have spoken about from time to time. But the UK today, we think, really is looking at outstanding value in comparison to other global markets. And when you look at the valuation of the UK, the MSCI UK market, X the banks and the oils, which are very strong components of the market and always swing that valuation. So when you look at the more like the median company within the UK market, it's trading at a substantial discount to the rest of the world. And I think that's important. And when you look more specifically, this sort of data is useful on a top-down basis. But when you look specifically at individual companies, you see that Unilever and Reckitt Benckiser, for example, are trading at a 20 to 30% discount on a PE multiple to stocks like Procter & Gamble or Nestle, which are close peers, but listed in the US and listed in Switzerland. And we think that gives an extra resilience to the portfolio, gives you a little bit of extra yield, and that's very, very important. And the final point is that the UK has culturally been a very strong market for dividends. UK companies pay dividends. US companies tend to do more buybacks, and that means that the UK market has traditionally had a slightly higher yield. And what's really important is that we think that certain parts of that market and certain aspects of that yield can be relied upon to grow steadily for many years to come, and that's where we're really focusing the portfolio. This next slide is a little bit busy, and please forgive me for that. But what it shows across the horizontal axis is the yield cohorts. So you've got first bar is 0 to 1% yielding stocks, 1 to 2, 2 to 3, and all the way up to stocks yielding more than 8%. And what the vertical bars show is over time, what has been the average change in that dividend in the year following the measurement of that yield. And what you can see is that low yielding stocks tend to grow their dividends much faster until you get to in the region of 4 or 5%. And then what you start to see is the market pricing in dividend cuts and those dividends being cut over the short term. And what we feel is really important is that we don't overstretch for yield. It's been a huge temptation over the last 5-10 years where interest rates have been at zero to really push into that area where effectively you're trading off income for capital return. The higher you push the income, the more you risk the capital. We want to stay in the zone of 2 to 4%, not religiously, not dogmatically, but that is the core and the sweet spot of where we want to be in that 2 to 4% dividend yielding stocks, where those dividends can grow between 8 and 5%. And if we can deliver that income, that 3% yield with somewhere between a 5 and 8% growth, you end up with what is essentially a high single digit total return for investors, rather than overreaching for yield and giving up the capital return. And we've been very careful to make sure that we maintain the portfolio in that position. And we think that importantly, as you start to see yields come back in fixed income, on cash, in other asset classes, that it is that growth in the dividend from equities that really separates equities out as a class, an asset class. It really is the compelling reason to invest in UK income, is the fact that if those dividends are carefully selected, we can be confident that they're going to grow steadily over time. And that's what preserves the real value of investments. That's what helps you combat the insidious impact of inflation and really delivers the long-term returns that we think that long-term savers need. The portfolio, when you look at its construction, I won't dwell on this for too long, but when you look at the portfolio construction, what you can see is that there's a core in blue in the top right-hand part of this wheel that is consumer staples and healthcare stocks. These are resilient, defensive, less economically sensitive stocks that pay their dividends year in, year out. So roughly 3%, growing at mid-single digits to low single digits. And that is the income generating core of the portfolio. That is the part of the portfolio we expect to be more defensive in more difficult markets. Around the bottom in the green, you've got some higher growth sectors. You've got specialty chemicals. These are the Crodas, the Bunzells of this world, and industrials and diplomas. These are the stocks that we think can add a bit of growth. They typically yield a little bit less. And then, and it's important to recognise this isn't a sort of GIC sector. This is how we look at the market. And we think there's a lot of stocks that sit in other sectors, which are actually shown at the bottom of this pie chart, which are much more exposed to software and data and platforms. And we think these are the sort of the nuts and bolts of tech. They're not the glamorous stocks at the front edge of this, which have are not necessarily profitable or not necessarily paying dividends. But these are the companies that underpin those data processes. And if you think about a stock like Experian, providing credit data into the banks cannot operate without a stock like Experian. So they're almost business-to-business staples. And these, again, form a very strong growth driver in the portfolio. And at the top left, we've got two parts here. We've got some slightly more cyclical stocks in the orange, and these tend to be the financials and the consumer discretionary stocks. Again, making sure these are capital light. Stocks like Compass, like Intercontinental Hotels, which doesn't own its hotels. It's a franchise operator. You know, these are companies that we can be comfortable, although a little bit more cyclical, can still deliver strong long-term returns. And then at the top, some more defensive, slightly more capital intensive, but very economically insensitive stocks in terms of infrastructure and utilities. And these stocks typically have quite high yields. And actually what has been important to see from a number of these stocks is those yields, and the growth in those yields is linked to inflation. So National Grid growing its dividend by 9% this year has been an important feature of what these more regulated, steady Eddie stocks can do within the portfolio. Coming to the income and specifically talking about the dividend generating capacity of the portfolio, having talked about how important the ability to grow dividends is, I thought I'd give you a little bit of an insight into why we have that confidence. You can see here just a handful of stocks that give you an indication of what the portfolio can deliver. These are all stocks. Croda in the specialty chemicals industry provides the active ingredient in face creams and part of the components of COVID vaccines and other such vital ingredients. And this is a stock that has been able to grow its dividend without a break for 30 years at 12% on average, growing most recently in the most recent announcement 8%. Compass Group bounced back from the pandemic. The world's largest contract caterer has a fantastic network effect that allows it to take share in more difficult periods like this. Very steady long-term growth, but also very strong short-term growth as it bounces back from the pandemic. Bunzl distribution, another seemingly unglamorous stock that provides not for resale items to shops. So plastic cups that you receive your coffee in, and the equipment that they use to clean the coffee shop. And this is a amazingly stable business. Again, able to grow its dividend at 8% per annum over 20 years on average, and 30 years of unbroken track record. Diageo is a stock most of you will know well. Spirits, affordable luxury, something that people can buy. People are drinking better, not more, and Diageo's premiumization plays absolutely into that trend. And then Experian, which I've already touched on, providing the data of which much of the financial services operates. That snapshot, I think, is interesting, but we can all cherry pick. What's important to show on the right-hand side is that when you look as a percentage of the total income, over 50% of the stocks in the portfolio are growing their income more than 5%. And when you think that projections for the UK market are that dividends are going to be flat this year, we think that's a reasonable premium growth that we should be excited about, and gives an idea of the resilience of that portfolio growth. I've ended on talking about resilience there, and I think the resilience of the portfolio is that other key factor. So dividend growth being a hugely important driver of what we do, but resilience also. And this chart just shows the performance of the trust, the maximum drawdown. So if you bought ahead of each crisis at the worst time and sold at the bottom of the crisis, it shows how much the sector would have lost in grey, how much the market would have lost in red, and then in blue, what Troy Income and Growth Trust did. And you can see this through the US debt ceiling crisis of 2011, through the China slowdown in 2015-16, through the 2018 correction, and also through the COVID pandemic. The trust was much more resilient. For the income, the open-ended funds, we've also got this data going back through the global financial crisis. Obviously, we only took over management of the trust after that, but it shows a very similar performance. So we have a history of performing well in periods of market weakness, and that is because those dividends are robust. We've got resilient profits, and at the moment today, we believe that the valuations are also supportive of that sort of more resilient performance. What does that deliver in aggregate? Here you can see we've disaggregated returns through periods of rising and falling markets. You can see on the left, or I'll start in the middle, but you can see in the middle that idea that we protect capital more in those falling markets, suffering in aggregate about half the drawdown. What we give up is a slightly more modest performance in some very strong markets, and you can see that reflected on the left. But importantly, when you combine these two sets of periods, what you get on the right-hand side is that we outperform, we have historically outperformed in aggregate through the cycle and done so with much lower volatility. Finally, I'm just going to touch on the discount control mechanism. The investment trust world has from time to time been dogged by large and wide discounts in certain trusts. We feel that with liquid underlying securities, so liquid large blue chip equities, there is no reason to have investors locked in. And we run a discount control mechanism that ensures that the share price remains broadly within 1 to 2% either side of net asset value. So we're not starting to address the discount at a -5 or a -10. We're trying to keep it at 0 or thereabouts. And the important thing about that is that it also means that if there is excess supply of shares in the market, i.e. there are more sellers than buyers, the trust will buy back shares. And if there's excess demand, people want to invest in the trust, then the trust will issue shares. And what that means is that the liquidity of the trust is far, far greater than for many trusts of an equivalent size. The board are committed to this process. We're committed to it. All of the trusts we manage at Troy, SDS, Global Growth and Income, Personal Assets Trusts share this feature. And we think it is a very important thing for us to do to ensure that should savers or investors wish to redeem from the trust, they can do at a fair and reasonable price that reflects the underlying value of their assets. With that, I will just sum up quickly and hand you back to Alex. I think there are 3 key messages. One is that this is a well-established process that we've been running since 2004 at Troy. We've been implementing in relation to Troy Income Growth Trust since 2009, but it's based on those consistency of those aims and the idea of steady outperformance, resilient performance, and growing income. Today, we think that the UK is an attractive market for income investors, especially those looking to grow their income, and that the portfolio stocks that we hold in the portfolio today can deliver that into the future for our shareholders. So thank you all, and I'll hand you back to Alex for questions.
Great, thanks Hugo, and thank you for taking the time to give this presentation today. To everyone present, I would just like to encourage you all to continue sending in your questions using the Q&A tab on the right-hand corner of your screen. As we go over the questions we've received so far, I want to point out that a recording of this presentation together with the slides and the published Q&A will be accessible on the events page shortly after this call. I'd like to express my gratitude to everyone participating in the call and for their active involvement in submitting questions. Hugo, you can see in the Q&A tab that we've got a number of questions that have come in so far. So I will make a start with addressing these to you. Firstly, you touched on your international exposure, but could you just remind us exactly what that is and what you look for in overseas stocks?
Yeah, I think overseas stocks fulfill a number of roles within the portfolio, and we have a commitment to be 80% invested in UK equities, UK listed equities. But we can obviously, and we do have some flexibility to invest overseas. And really what we're looking for here is either business models that aren't represented in the UK or some diversification from the UK, or alternatively a valuation gain. So in the holdings that I mentioned so far in terms of Nestle and P&G, that is about diversifying across a wider set of stock-specific risks. It is a core part of our portfolio, those consumer staples stocks. We've been reducing P&G and Nestle because of that valuation point I made, but they're still held in the portfolio, and we think that that's a useful use of that overseas allocation. From time to time, we find stocks that are not replicated in the UK. We recently bought Roche, a Swiss pharmaceutical stock. And that is a stock that we feel has a much better, is a much stronger stock than either the UK pharma companies when you look at the breadth of their R&D and the depth of their R&D, and especially when you consider the valuation that AstraZeneca currently trades on. So that's another good example. And then there are exposures that we just can't get elsewhere, and we're invested in CME Group, which is the old Chicago Mercantile Exchange. That is an exchange that is very focused on futures. It is, again, a data provider, an exciting opportunity that is not readily replicated in the UK, especially during a period when London Stock Exchange was integrating its Refinitiv acquisition. Paycheck's another good example of a stock that we own today. Does payroll for US companies, manages those payroll systems, and has been a very good investment since we bought it at the lows of the pandemic, when people were deeply concerned about employment and employment numbers. So those opportunities come around from time to time. We've also held stocks like Amex in this portfolio. We sold it. They have a little bit more cyclicality than we're comfortable with, given our current outlook. But that is a stock. Those payment networks, Amex, Visa, MasterCard, are not replicated in the UK and are not places that or stocks that would be able to hold if we were restricted only to, or business models that would be able to invest in if we were restricted only to the UK.
Hugo, you touched towards the end of your presentation on how the trust protects on the downside. But how do you think you'll perform in a recessionary environment as opposed to a market downside?
Yeah, I think there's a couple of slides that I think are important to talk to here, and I think this picture is constantly evolving. What we show here is the US 2-year Treasury note, and you can see that now at about 4.7. That's slightly out of date on the right-hand side. You can see on the left-hand side the rate at which rates have increased in the US, and obviously very similarly in the UK in comparison to previous periods of central bank tightening. And I think the point is, without going through each of the individual different periods of tightening, is that this time around rates have increased faster and further than in most other tightening cycles. And that inevitably has an impact on the ability of the economy to continue to grow as monetary policy becomes tighter and credit becomes tighter. The UK in particular, where we saw another 50 basis points very recently from the Bank of England, I think it is at risk of that tightening dramatically slowing the economy. And when we look at that, we want to be very clear and very careful about how resilient the portfolio is. And I think there's a number of things that give us confidence on this. The first, I think, here is valuations. And 2 years ago, 18 months ago, this would have been a very different picture. And what this chart shows is it's not all of the stocks. It becomes very crowded if you put all the stocks on here. And this isn't universally true for every stock in the portfolio either. But if you look at the 10-year PE range, which this shows for a number of stocks, ranging from very core holdings like Diageo on the left through to some of our smaller holdings, what you can see is that these stocks are now trading towards the bottom end of that PE range. And that gives us confidence that these are companies that are relatively attractively valued. So we're not going to see massive PE multiple contraction from here. We may see some, but not massive. The other thing that gives us a huge amount of confidence, I think, is the past performance. I spoke to the aggregate past performance of the fund at the trust level, but when you look at down underneath that of what happens with individual stocks and their revenues and their profits, what we can see looking at both the pandemic and the global financial crisis, which are the two biggest drawdowns we've had in sort of recent memory, is that the revenues of our current portfolio of stocks have historically fallen less than 20% of what the market fall has been. The profits have fallen less than half of what the profit correction has been for the wider market. So these are companies that are resilient, and we see that flow through into the dividends. Historically, these companies, with the exception of Compass Group, the top 15 companies in the portfolio, didn't cut their dividends during either the global financial crisis or during the pandemic. A few of them held them flat, as you would expect. Compass cut in an exceptional environment where their end market's almost entirely closed. And when you aggregate that together, you get a picture of stocks that we really feel has the ability to be resilient. And if we can get through the initial stages of a market downturn with our investors' capital intact, that really gives us the opportunity at a later stage to potentially either gear the trust or to take a little bit of more risk when we think those valuations and earnings are fully based out and participate more fully in the upside. And that's an exciting opportunity for us. But I think where we sit today, we're still relatively cautious, and we're comfortable that the portfolio has that resilience baked into it.
Thank you. You touched on your discount control mechanism. We've got a question here just asking how strict is that? And then a question for me in relation to that is, what is the impact on your DCM, on your total assets?
So the discount control mechanism, I think, as I explained, is something that we are very attached to at Troy. We think it's a necessary and the correct transfer of risk from you, our investors, to us as the managers, in the same way as it is with an open-ended fund. And we are pretty religious about it, and it has been something that we have managed unfalteringly since we were just shortly after we were appointed to the trust, and we put it in place at the first EGM. It's run by Juniper Partners, who are the trust administrators, and they speak to the market and the brokers every single day, and they are there to buy back shares every single day. So it's not a decision taken by the board to buy back shares on a particular day or in a particular quarter. It is there day in, day out. Then the impact on the assets under management is one of periods of issuance and periods of repurchases. And I think that's as to be expected with any pool of capital that is effectively not fixed. I said at the beginning that the trust was about between 40 and 50 million when we first took it on. We've more than doubled the share count of the trust over the period that we've managed it. We've had 3 very short periods of buy-ins after we initially put it in place, many periods of issuance, and at the moment we're currently in a position, as I think a lot of people are in the UK market, of providing liquidity to the market and buying in shares. But we're not. That doesn't fundamentally concern us. It is important to give investors that confidence that they can sell their shares when they want to at net asset value, and we are very happy that that, as it always has done in the past, will change in fairly short order into issuance of shares, and that's how we grow the trust as well as through the performance, and ultimately that growth of the trust has the ability to dilute the cost for shareholders.
Great, thank you. A number of these other questions I think we've already had answers to. Just one more here. You list Bunzl and LSE as significant recent additions, and Halion and Halma as significant sales. Can you just go into what drove those transactions?
Yeah, I think I'll flip to the transaction slide more broadly and just talk about what we've been doing in the trust, and perhaps move from left to right on this. I spoke about valuations, and you can clearly see from the slide here that the reductions have been across a number of stocks recently: Procter & Gamble, Paychex, AstraZeneca, and Experian. And the common factor between all of these is that they are stocks that we have confidence in over the long term. but that we feel in the short term have become more acutely valued. And in the case of Procter & Gamble and Paychex, it's partly that overseas differential in valuation. AstraZeneca has performed exceptionally well. Experian, being exceptionally high quality stock, has always traded at a higher valuation. And we just feel with a little bit of more cyclicality potentially coming into the market, that we want to be a little bit more cautious about that. Haleon and Halma, as sales, Haleon was spun out of GlaxoSmithKline relatively recently, and came out with a considerable amount of debt that it was going to have to pay back, and also an overhang on the Zantac product, which has been subject to litigation. It's an anti-heartburn medication that's available over the counter, and provided a little bit of extra uncertainty around that stock. But we are careful about leverage, and Haleon coming to the market with 4 times net debt to EBITDA, especially in an environment where that interest burden, that cost of that interest is likely to rise over time, is concerning. And we're very clear that the cash that companies generate serves 3 important purposes. The first of those one of those is to pay the dividend, and clearly that's very important to us and our investors. But there must also be enough cash left over to manage the balance sheet. And in an environment like that means paying down debt as debt becomes more expensive, delevering, and also reinvesting for growth. And the companies that we generally own are high return. And I think it's appropriate that we feel that companies that have too much of their free cash flow going to address their debt burden or pay down debt are a little bit more constrained. And so Haleon, although a fantastic group of assets and a stock we may well own in the future, at the moment just doesn't feel right in the portfolio. Halma is one of the best UK industrials there is out there, but again, a very skinny yield at 0.9% today, and with a valuation of around about 30 times. If we're going into a more difficult environment, it was a small holding because it was very low yield. We felt it was appropriate to reinvest that in something that was a little bit less cyclically exposed, had a higher yield, and was more core to the sort of stocks that we hold in the portfolio. And then you've got the additions on the left-hand side, and Bunzl and LSE Group are 2 that we've been topping up. We bought those both relatively recently. LSE Group, after we went through the process of effectively bedding in the Refinitiv acquisition. LSE is the London Stock Exchange, but it is also a fabulous collection of other businesses. It runs FTSE Russell, the index provider, and it also runs a London clearinghouse. Again, this is a business that is embedded into the London and the global financial system, providing data, providing liquidity, providing the ability to transact. And it does that very profitably with delivering a return on invested capital of 20 to 30%. And I think once we were happy that the Refinitiv acquisition was bedding in well, we were happy to buy that stock on a 20 times multiple versus a 25 times, which is sort of more where it had been prior to this. Bunzl, I spoke a little bit about being a distribution business, and I won't go into that in a huge amount more detail. But these are the sorts of businesses, along with the likes of Sage and Smiths, which form the core of the income generating ability of the portfolio. And then I think the last one that's worth just touching on is Howden Joinery, because it does something slightly different in the portfolio. There's a slightly different rationale for buying it. You may not be aware of the Howden Joinery brand, but effectively they make kitchens. And the interesting thing about them as a kitchen manufacturer is that their relationship is with your builder rather than with you. And so as a retail, as somebody who is buying kitchens as an individual, you are likely only to buy a handful of kitchens in your life, 1, 2, maybe 3, if you move house frequently. And so that cost of that acquisition of the customer is very high for someone who sells to retail. If Howden develop the relationship with the builders and the trade, the builders and the trade are buying multiple kitchens each year, and they will recommend Howden to you. They will have the price discussions with Howden, and that relationship becomes very, very strong. That is a more cyclical business, and we're very aware of that. And today, it's a 1% holding in the portfolio. It could be significantly larger than that, so 2 or 3%. But we would have to be very clear that both the valuation multiple and the earnings had both bottomed. And what we've seen is Howden derate prior to our purchase from about 40 times earnings to about 50 times earnings. Sorry, to about 15 times earnings. And so we've seen that valuation come down very markedly. We've also seen the earnings move. So we've seen earnings taken down, earnings estimates taken down by about 15%. So we're starting to get that confidence that the market is pricing in a more recessionary environment for a stock like Howden. This is exactly the sort of move that you might expect us to make more broadly across the portfolio if we start to see earnings significantly rebased down for some of our bench of stocks that we want to own, and those valuation multiples continue to improve.
Hugo, thank you very much. We are at time, but before we conclude, just one very sort of final question, please. There are a number of trusts and funds that approach UK equity income opportunity in different ways. In 1 minute, what is your USP and what gives you the edge over competing products out there?
I think there's a couple of things, and I will keep it short. I think the discount control mechanism and that focus on producing a smoother journey for our investors is different to many in the trust. And I showed you the risk return and the volatility that the trust has delivered over time, and that is markedly different to the rest of the sector. So for people who want a more sleep at night experience, don't want to be waking up to find huge volatility within our portfolio, Troy Income and Growth Trust can play an important role there. And I think the other thing that differentiates us perhaps is this idea of focusing on income growth rather than high yield. And as I explained earlier, the high yield is potentially higher risk. You give up capital if you overreach on that yield. The temptation to do that, to deliver a premium to bonds today is high. But we think the unique thing that equity can do for investors is deliver that growth and combat the impact of inflation. And so if we can combat the impact of inflation, grow that dividend steadily and protect your capital in periods of high volatility, then we'll be very happy with the job that we've done for our investors. And we hope we can deliver that.
Great. Well, many thanks again for your presentations this morning, Hugo. To all investors, we kindly request that you keep this session open, as we'll be automatically redirecting you to a feedback form. The insights from this form will greatly assist the management team in understanding your perspectives and expectations more clearly. We sincerely appreciate your participation in today's presentation, and we'll now bring this session to a close. Thank you very much indeed, and goodbye.
Thank you.